Well, good morning, John. It's good to see you. We're recording this on the 1st of August. John, July was a pretty good month. Mostly the narrative was all about tariffs and so on and what Trump's White House is going to do. But the share markets globally managed to rise. About the 10 big markets that I follow were all up about 2 to 3%. Is tariffs today's story but not tomorrow's, or are markets just going ahead based on their earnings?
Well, I think we're seeing that tariffs aren't the end of the world. I think that's the first issue, and obviously the first suggestion of the rate of tariffs is being substantially downgraded. There was always the expectation of 10%, but it looks like it's rounding out at about 15%, give or take. So that hasn't been a shock. I guess if it was 50%, you'd have a much different effect on markets. And I think the other issue, I think there's been some sensible deals done in terms of America negotiating its exports into Europe on defence and energy. I think that's sensible. But that was always in train, so it's not as if it's a new announcement, and we've been picking up on that for the last few months, Paul, so that's not new. But the thing that's come out of the blue is the agreement by Europe and Japan, and I think even South Korea today, to invest in American assets. And it needs a lot more clarification. I can't follow it, but I did hear an interview last night with the head of Treasury. He said it wasn't, with the South Korean deal, it wasn't regarding bonds or Treasury issues. So what is it? Very unclear. I suspect a lot of these foreign governments will buy American Treasuries, and probably for the term of Trump's presidency, and match it out and see what happens with the next president, if that makes sense. But that's what I think is happening. And the American bond market's been fairly solid on the back of that.
It certainly has, although bond markets did weaken over the course of the month. John, some earnings have come out of the US. We're in the midst of earnings season. I think a day or two ago, it was the turn of Microsoft and Meta, which owns Facebook. Both shot out the lights and performed very well. Are we seeing, a continuation of stellar results from America? Is that what's driving the Wall Street at the moment?
Well, it's against the trend lines of the underlying economy, which are not dramatically good in America. They're just growing slowly. Growing at a slower rate as these tariffs work through. But the weakness in the US dollar, I think, has an effect on multinationals reporting their earnings. So there's some effect there. And it was a quarter of weak US dollar. And then the emergence now of artificial intelligence, the productivity improvements, which is really going to be grabbed by these mega companies. I mean, there's clearly being established a productivity leg growth factor coming through the IT sector of America and the multinational sector of America. So it is good. I mean, that's good because they have to grow earnings to justify a lot of their multiples in the stock market. So that's good. So it's justifying that. And it gives some confidence that there is a productivity payback on AI. And I understand that's going to be discussed in Australia at our productivity roundtable in a few weeks. We've mentioned this before. I don't know whether we're at the forefront of AI, but certainly we'll be a beneficiary in a couple of years when it stabilises, and we know what the winning AI solution is. Because there's a lot being rolled out at present. And as I said last week, they all can't be winners. There's going to be ultimately a couple of solutions which will be grabbed by the whole world order as the preferred technology.
Yeah, we'll get to the Productivity Commission roundtable in a minute, but let's just stick with the global share markets, because the IMF has put out a new report upgrading its forecast for global growth, and that includes better growth in the US, better growth in China, importantly from 4 to 4.8%, but better growth expected in Australia from 1.8 to 1.9 or 1.9 to 2% for 2026. But it seems to be based on the back of expecting that global tariffs will be lower than they had initially thought. So this is feeding markets undoubtedly. Do you put much credibility in the IMF forecasts, or just one more economist's voice?
Well, it's fairly well rounded. I mean, you picked up on the fact that they downgraded with Liberation Day tariffs, and now they're upgrading as they see the actual
Yeah,
tariff numbers come through. So there's a little bounce back. They're not dynamic growth numbers when you think about it. They are
no,
below longer term trends. So, but as we've always said, Paul, the world's not going into a recession. It's slower, steady growth. Now, when you scan the world, China's uplift is pretty interesting because it's in response to the tariffs, and they're obviously pump priming. And China's export growth continues unabated around America, so they're still continuing to grow despite all the doomsayers. Europe's had a bit of a kick. It was going nowhere, and now the good news is that Trump has stirred them up into investing in growth. And
yeah,
unfortunately, it's mainly defence, but the re-targeting of or resupply of energy away from Russia to the rest of the world, and particularly America, is good news.
yeah.
So there's reason to be fairly, not excessively optimistic, but to say, look, there is no recession nigh. There is issues in America, which we constantly come back to, and the tariffs are now rolling out. We've had this hiatus period. Looking at some of the numbers in America, the economic growth numbers in June quarter were, okay, nothing dramatic. But
3%.
yeah, but what I say, not dramatic, because they had a big kick because imports were down after surging. So we had a poor March quarter with imports racing up, and a better June quarter as imports were slowed because of the stock build up. So when you look through the numbers, 3% annual is overstating it probably by half to 1%. So it's growing around 2%, which for America is below. And I keep on making the point they're growing at 2 to 3%, with a budget deficit of 6%. So there's massive pump priming going on through the deficit. The growth is not coming through. Australia is growing its economy at a faster rate than its deficit. That's interesting. Our deficit forecast at 40 odd trillion, so that's about 1.25% of GDP, and we're growing, as you said, at 1.9%. So we're growing faster than our fiscal deficit. America's not. So there's interesting numbers we have to consider here, and look through these headlines.
John, in the meantime, since we met last week, the Fed has sat on its hands with this interest rate decision. It's put the next cutoff to September if it happens, which I think it will. But the RBA received the quarterly CPI number, and now our futures are suggesting that there's more than a 90% chance we'll get that cut that we expected last month. We'll get it on the 12th of August. Are you expecting a cut, and you expecting that to give a bit of a boost to the economy?
Well, if you believe the guidance of the RBA, there will be a cut. They are now in a quandary again because, as I keep on saying, the American Federal Reserve is not cutting, and we are in a cutting regime and opening up the margin between cash rates in Australia and America, so the free carry, which puts pressure back on the Aussie dollar. And as a big importer of merchandise, we will start importing inflation again through a weaker currency. So good news and bad news all wrapped up in one. The Australian Central Bank would love the Federal Reserve to start cutting, and we cut in unison. And then we might get some continuation in the revaluation of the Australian dollar, which would help the inflation story. But I think we're building up, unfortunately, if the American Federal Reserve stalls, which it looks like it will, and they're not that strong that they are going to cut in September. And so that's interesting. I mean, Jerome Powell wasn't really overly bullish, even though he had 2 dissenting votes, which is quite unique in America. So we have to acknowledge that. But if they don't cut and we cut, there's a problem in 2026 for Australia's inflation, and we may see inflation bottom and start slowly rising again. So it's a bit of a quandary, but I take your point. I think we've got another 0.25% cut, which will put a bit of free cash flow into the mortgage belt.
John, let's end the session with a bit of a chat about this productivity commission that we referred to a few times. I think it's on the 18th to the 20th or something of this month. The Fin Review is running a lead story this morning saying that there'll be a proposal to reduce company tax rate from 30% down to 20% on small and medium-sized businesses. And to pay for that, there'll be a cash flow tax, if you like, of 5% on all companies. Is this something that you think is worth debating? Does it make sense to you on the face of it, or is it interesting? Is it adding to the debate?
Certainly interesting, and
Yeah.
something I've talked about in some of my writings. Look, the great debate about the budget is, and you've pinpointed it in an article in First Things this week, Australia's budget is not so much a revenue collection problem, it's an expenditure problem, and we haven't got time to go through that. So the deficit is really driven by excessive expenditure against long-term ratio, so it's bad fiscal management. If we are going to collect tax, there's got to be better ways to collect tax, more fairer ways, and doing it in a way that stimulates productivity and also gets, a fair share of tax from foreigners. But let's get real here. Trump is changing the rules of play, the world tax order through, and that's what tariffs are, they're taxes. He's changing it unilaterally for his benefit, and time will tell whether it works. Australia's got to do the same thing. We've got to come up with tax rates and not be bogged down with international standards and do things which might be cutting edge. And revenue taxes, which in my world are prepayment of company taxes, so you pay your revenue tax and then you get a credit on what you should be paying or are going to be levied in terms of company tax, that makes sense to me.
Yeah.
And those who are avoiding tax, the community has captured their tax through the revenue tax, and particularly foreign entities, and particularly entities who are operating in tax-free jurisdictions, it gets some tax, and it shares that burden with entities who are benefiting from Australia's growth and Australia's clean economy. And I extend it, and I've said this, Paul, I think we need to have a similar sort of tax on turnover going through the stock market and other speculative markets. I mean, we've got too much nonsense money going through markets, speculating, utilising the strength of the Australian stock market and our capital ratios to trade endlessly and clip tickets, front run, short, do every diabolical trading strategy and then take the profits home to a tax haven. I mean, it's ridiculous. So I welcome this sort of logical debate, and I also welcome the fact that may allow smaller companies who are the growth engines of Australia to have a lower tax rate, to retain more capital to invest in growth. So it all makes sense to me. Whether these guys can cover this in 2 days' time will tell, and whether the Australian bureaucracy is ready for such a dramatic change will be interesting. And as I said last week, we need to have these forums every quarter. I mean, if this is a one-off think tank and then we'll see you again in 3 years' time, that would be a hopeless situation. I'd like to see this think tank say, look, we're going to take these ideas and we're going to have another think tank before Christmas to review what we're going to run with, and then continuous think tanks about reviewing process and progress. So that's what I think should happen. So I'm all for it.
Well, a lot more to be said and discussed about productivity and the lack thereof in Australia over the last few years.
Yeah, but this is finished. But your article says it all. It's clear the growth in government employment and some of these social security systems, some of it's good stuff, but it drives down productivity. It doesn't increase productivity.
Yeah.
And Australia's got to start using government expenditure more so for driving growth and not filling black holes. And I think we've since COVID, we've slipped and slided into the black hole expenditure. So it's time to review it.
Thanks, John. Well, thank you very much for watching and listening to us, and we will see you next week.
See ya.